How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. Today's topic, I want to go in depth about hybrid annuity scams and how to really avoid some of the really crappy products out there. Being able to see it coming from afar, being able to really shoot holes through some of the top hybrid annuity contracts to make sure if your situation pertains to a hybrid annuity as the best result, how to pick the proper one depending upon your area, depending upon your financial situation, and mainly your financial goals. So what happens is what a hybrid annuity is it's nothing more than a fixed index, or at least the hybrid annuities I'm speaking about, is a fixed index annuity with an income rider. So what happens is you have the fixed index annuity aspect regarding the safety, regarding your account to gain when the markets go up and not lose anything whenever the markets go down. So you have that safe, consistent growth potential in with hybrid annuities, and you're attaching an income rider onto those types of accounts for lifetime income, either immediately or at a later date and time. So if somebody understands the basics of an annuity, they understand that they could use a portion of their dollars, whether that be in retirement accounts, whether that be in cash accounts, whatever the case may be. You could place it in with this type of annuity contract. Now, annuities have to be set up through insurance companies. Banks cannot set up an annuity. It has to have specific legal reserve structures for that safety aspect. That's why, insurance companies can't offer bank CDs, and banks cannot offer annuity contracts. Each one has to stay within their lane. But what happens is an individual could go and leverage a portion of their dollars and for lifetime income at a later date and time or immediately. So you could have the old-fashioned type of annuities that go through a process known as annuitization. And what that means is this individual, and let's say we have an individual that's age 60 that wants to trigger lifetime income and he has $100,000. Well, if we're going through the old-fashioned type of annuities, well, this person would say, okay, I have $100,000. Which insurance company is going to give me the best rate of return, the best income stream from that this $100,000 would provide? So if we have a male age 60, the way that the insurance companies calculate their numbers is it goes off from mortality tables saying, okay, what are our projections on how long this male age 60 is going to pass away? So maybe you might have company A that gives this guy an offer of $6,000 per year for the rest of his life. Company B might give him $7,000 per year for the rest of his life. The risk for this person is saying, okay, if I provide the insurance company $100,000, well, then they're going to give me, I'm going to go with company B because they're going to provide me $7,000 each and every year until the day that I pass away. The risk on his aspect is saying if he passes away after the first year, well, now the insurance company is walking away with $93,000 of pure profit. And that's a basic type of annuity. It's known as a life-only immediate annuity. Now, the risk from the insurance company's aspect is saying, let's say if this guy lives until 100 years old, well, now they're paying out $7,000 each and every year till this guy lives to, let's say he passes away at age 100. So we could say, okay, that's 40 years. So 7,000 times 40 years is $280,000. So it took him $100,000 to receive $280,000 worth of payments. So it made sense to do that sort of contract. With a hybrid annuity, it's a little bit different because individuals don't want to have that risk. Individuals want to say, hey, listen, I want to use an insurance company for lifetime income, but if I pass away too soon, I want whatever's remaining in my account value to go to my beneficiaries. On top of that, the way that the account value is sitting there, rather than just keep depleting out that money each and every year, I want that to grow whenever the market goes up based upon my stock market index that I choose, and go flat, meaning gain 0% whenever the market goes down. So it gives you that combination of, yes, safe, consistent growth potential, but ultimately the reason why somebody's using a hybrid annuity is either as a maximum income play or a maximum death benefit play. So I hope that all of that makes sense. So that's the difference between going with an income rider versus an annuitization. I absolutely hate annuitization because it makes the individual lose control of their money and say, oh, well, tough luck. You just basically surrendered it over to the insurance company. And the insurance companies are always going to marketing about immediate annuities, about annuitization. This is exactly what your payout factor is because it's going to be their incentive to do so because that's how they make their most money. That's how they make their most profit. So when we're looking at the hybrid annuities, well, we understand, okay, annuitization versus income rider. if that same scenario, let's say this person has $100,000 with the annuitization option, maybe the top company gives him $7,000 of a payment for the rest of his life. Maybe with a hybrid annuity, you have $6,500 is going to go to this person for the rest of their life. But if, God forbid, whenever this person passes away, whatever's still remaining in the account value, because of that fixed index annuity aspect, that's what's going to go to his beneficiaries. Or let's say in 5 years, he's triggering lifetime income for all 5 years, and then now he has to dip into his account because he came into some sort of emergency. Well, now he could do so. Or maybe he came into a long-term care scenario. You have different companies that could double that income for him for up to 5 years or whatever the case may be. So there's so many different nuances that you could attach with hybrid annuities for those benefits, but the number one trick is avoid the mistakes, because income riders are not as good. They're more smoke and mirrors. They're more fluff than anything. So it's how exactly do you distinguish which income rider is good to which income rider is bad? How do you choose company A over company B, or company XYZ over company A and company B? So you just want to make sure that we're honing in on the income rider. And that's what brings me to my next point, is avoid the income rider smoke and mirrors. If we have a contract, and let's say we use that same individual, male age 60, but let's say he wants to trigger income at exactly age 65, and we're using a $100,000 example. We might have company A versus company B, right? Company A, let's say that they're giving him on his income account through his income rider, they're providing a 8% guarantee off of his original $100,000. So understand, this 8% is not his true money. This 8% is not something that's going to keep growing into his account value each and every year, like a fixed percentage rate, like a bank CD or a fixed annuity that would give you a straight fixed percentage rate. This is more that smoke and mirrors. All it says is this is a calculation account to determine how much lifetime income is going to be provided to this individual at age 65. So if we're using, let's say company A is giving 8%, but then company B is giving 6% of a roll-up. And let's say both this is simple interest, just for really easy math. So we have the first year, this person goes and places in $100,000. After year one, we understand that he grew to $108,000. Year two, it grew to $116,000. Year three, it grew to $124,000. Year four, it grew to $132,000. And then year five, it grew to $140,000. So now we have this individual age 65, and company A shows $140,000 sitting as his income account, as opposed to company B, which if we're increasing that by 6% each and every year, this is sitting at $130,000. So when you're looking at these, the individual says, oh my gosh, this income account looks $140,000. This should definitely is going to be the product, company A beats the heck out of company B. And that's simply not the case. Remember, always realize what's the trick, what's the smoke and mirrors approach with these companies. They're not going to be nice. They're always looking to generate a profit. So how can you shoot holes into this type of program? And what happens is maybe company A might give a payout percentage at age 65 of 4%, as opposed to company B, which has a payout percentage of 5%. So what this says is at age 65, company A, what they do is they take whatever the income account value is multiplied by that payout percentage rate, which equals that lifetime income for that person's for the rest of that person's life, as opposed to company B taking the same 130 multiplied by that payout percentage, something known as payout rate or income rate, or benefit rate, whatever the case may be. Each company has their own nuance of that word. 130 multiplied by that payout rate of 5%. So if we utilize a calculator, and I have $140,000 multiplied by 0.04, we understand that that's $5,600 is going to go to this person for the rest of his life. So $5,600 each and every year. It took him $100,000, and the company is now providing $5,600 for the rest of this person's life. Now company B, if we use a calculator again, we're utilizing that same $100,000 example. So now this grew $130,000 multiplied by a different payout percentage equals a 6.5 or $6,500 of an income payout or an income stream. So what we understand is if we break this down into percentages, some individuals utilize the term cash flow, other individuals utilize the term payment stream or payout stream. What this shows you is with company A, for the $100,000 that you're placing in there, you have a 5.6% cash flow that you're receiving out of that. company B, you have a 6.5% cash flow. So even though company A on the surface said, oh, this gives you an 8% guarantee, this gives you a 6% guarantee, the smoke and mirrors goes and leads us towards company B is going to blow company A out of the water. It's a much better product line if we're looking for max cash flow or looking for max income at that later date and time. In this example, this individual had the goal of retiring at age 65 to then trigger lifetime income. Now, why are those differences important? And the reason why they're important is because with any sort of plan, retirement plan, what I've noticed is the way that when we have a bunch of calls that come in all throughout the nation on a national basis, at any point in time that you found value in this, give our 1-800 number a call. We have 24/7 customer service. But what happens is we understand that the most successful individuals that set up their plan properly, it's not somebody that's always looking to risk and always saying, oh, I've made all this great gain into the market, because as fast as the market or their accounts might gain, those accounts could also crash, just like in 2008. You had individuals that had millions of dollars that then looked at their portfolio after the year was done, and they only had $500,000 sitting into their account. They took over 50% hits into their account. So when you're setting up a retirement plan, what we want to make sure is 3 main criteria are covered. First off, do you have proper income sources that are coming to you at that specified date and time? With the individual age 60 that are looking to retire at age 65, maybe he has Social Security that's coming to him at age 65. Maybe he has pension income that's coming to him at age 65. And then the other portion that he has to pull from is savings. So if we have Social Security income of, let's say, that's coming in at $24,000, then we have the pension that's giving him another $10,000 per year. But he has a goal, an income goal of $50,000. So we understand the 24 and the $10,000 equals 34,000. He has a $16,000 annual gap. Well, rather than taking a big guessing game and say, oh, I'll leave my money in the market and just try pulling all that money out, well, you run that risk of paying mutual fund related fees or market related fees, advisor fees, downward market loss, and you're pulling from an account that could potentially go down. That is just quadruple negative aspect, tornado vortex going against your account. So when you set up these hybrid annuities properly, we understand that the gap is $16,000. Well, what exactly are the smallest amount of dollars that you could leverage into specific safe income producing products that allow you to still have control? That's why we were using a hybrid annuity over a deferred income annuity or something known as a QLAC or something known as an immediate annuity. The reason why we're using the hybrid annuity is because we want to keep control at all times, and then we want to maximize out what that cash flow is. If we have company A that says, okay, for that $16,000, it's going to cost you $250,000, or company B says for that same $16,000 result that we want to trigger at age 65, maybe it's going to cost us $175,000. Why in the heck would you go with company A that you have to generate more money? You have to give more money to the insurance company just to get that same $16,000 rather than go with company B, which you obviously are saving yourself $75,000 in the process. So it's all about placing a smallest amount of dollars in there, but as much as necessary. A smallest amount of dollars in there, but making sure that you're getting the best bang for your buck. So that covers the income source properly. The second aspect is, well, when you do that properly, you're going to maximize your cash accounts. You're going to maximize your emergency accounts each and every year. So it's all about making sure that you have enough dollars in liquid cash. God forbid something was to happen or you want to take a vacation, whatever the case may be, you could pull from that account easily. You could make sure, hey, I have that peace of mind. I have my income is covered. Everything looks perfect. The very last aspect is something that we specialize in, and it goes off of inflationary protection. What happens is typically you have individuals that they'll go and they'll plan for a specific income play and say, okay, based upon this person's situation, he has $50,000 in bills each and every year, so we're just going to trigger something that's going to give him $16,000 of income. What makes us a little bit more unique is we understand that inflation is going to increase by around 3 to 4% per year. So out of that $50,000, maybe $40,000 is fixed expenses, but $10,000 are inflationary expenses, meaning that's going to tick up by 3% each and every year. So what we want to do is say, okay, at age 65, we're going to receive $50,000. Maybe at age 69, he's going to step up to $56,000. Maybe at age 72, it's going to step up again to receive $61,000, whatever that case may be, but we want to make sure that all 3 of those bases are covered, and that's how somebody's able to successfully retire. So I hope that this video made a lot of sense. Let me clear up the screen. If you found value in this video and you you want to see more information and say, okay, well, based upon my area, I understand that I have hundreds of different carriers that are making hybrid annuity offers or just different types of income offers, guaranteed income offers. How can I distinguish from a good company versus a bad company? And that's something that we really specialize in. We're an independent agency, so we have access to every carrier, every contract out there, and then we have proprietary strategies. We leverage something known as a Retire Sharp planning system. It's specific to our organization, hence their website is retiresharp.com. YouTube channel is Retire Sharp. And what it allows us to do is say, okay, based upon those three main criteria, how can we make sure that we're placing the smallest amount of dollars into any sort of vehicle out there, whether that be annuities, whether that be other types of financial products, to produce that income, to make sure that you have the peace of mind with income, you have max emergency funds, and then we're also setting up a plan for inflation. We've always had very good reviews, and it's because of that methodical process. We're our A+ rate on the Better Business Bureau. We've never had any complaints, always had good reviews, and I want you to kind of do your due diligence of the company and give us a call whenever you have questions. We offer 24/7 customer service. We implemented that a couple of years ago, so at any point in time, it could be mornings, nights, weekends, holidays, whatever the case may be. If you want to give us a call, we'll have a specialist standing by to try to help out your situation. I want to thank you very much for watching this video. Please make sure to subscribe to our YouTube channel, Retire Sharp, so you could have the most access to the so you could have access to the most updated videos.